How to benefit from inflation for maximizing profit and protection with life insurance. Inflation, debt, and taxes are three wealth thieves that diminish our lives year after year. Over the dinner table, families often sit and talk over the years gone by. For instance, in the 70s, when Sholay was released in the theater, the ticket price was just 4 rupees 50 paisa. Now it costs around rupees 200 per ticket at the multiplex. The reason for these price differences is simple and straightforward: inflation. Harnessing and riding the inflation tide to our advantage with life insurance. Inflation and time value of money. Inflation is the rate at which the value of a currency declines over time. The impact of inflation has on the time value of money is the concept that a sum of money is worth more now than the same sum will be in the future. Over time, commodity prices rise and the value of rupee declines. For example, rupees 1 lakh in 2021 has already decreased to rupees 94,000 in 2022 and reduced further to rupees 88,360 in 2023 with a 6% rate of inflation. Over a period of time, prices of each and every commodity is going to go up. How does a misled mindset about inflation impact life insurance? Life insurance offers a unique advantage compared to other financial instruments. Unlike most assets that appreciate over time, life insurance provides a natural hedge against inflation, ensuring the protection of the policyholder's assets. The premium for life insurance is typically a fixed rate paid over the payment term, utilizing the concept of rupee cost averaging. The premium does not rise with inflation or change with market fluctuations. Salary hike. Salary hikes to be higher than 10% study. 5 in 10 employees expect more than 12% salary increase in 2023, according to the survey. Salary hikes are typically given to employees to keep up with inflation. With inflation, as the years pass by, the value of the rupee keeps falling. If salary hikes exceed inflation, we get double benefit. The rate of inflation enables depreciation of premium, which gets cheaper as the years pass. And the higher the rate of inflation, the lower present value of the future premiums. We get to pay with cheaper rupees as the years pass due to inflation. Inflation allows policy owners to pay premiums with money worth less than when it was originally bought. Insurance products also have an inbuilt ability for asset appreciation and wealth creation. This will ensure that our family has adequate financial protection whether we are alive or not. Take this example. If premiums were adjusted to rate of inflation and not be constant or fixed, not considering GST, rate of inflation is never fixed. This example is just for representation. We can see with each passing year, the value of premium keeps going up. That is, if the premiums were adjusted to the rate of inflation. That would be rupees 31 lakh 80,794.90 more in value over the total payment term instead of the rupees 1 crore total premium. But the premiums we pay are locked in for the life of the life insurance policy, meaning they won't rise and fall with inflation. Due to the time value of money or time factor of inflation, here's what happens actually. With inflation, with each passing year, the value of rupee drops by the corresponding rate of inflation. For example, note, rate of inflation is never fixed. This example is just for representation. For the same values as in the above example, except the value of the premiums fall with the corresponding rate of inflation. The value of the total premium paid at the end of the payment term is worth 76 lakhs 89,748.10. That would be 23 lakhs 10,251.90 less in value than the total premium paid over 10 years. Higher the inflation rate and longer the payment term, we gain more with further reduction in value of the annual premium. That is time factor of inflation on life insurance policies. Next example. Here we increase the rate of inflation to 10% from the 6% as in the example in the earlier slide. The value of the total premium paid at the end of the payment term is rupees 65 lakhs 13,215.60. That would be rupees 34 lakhs 86,784.39 less in value than the total premium paid over 10 years. The same principle applies to the commission paid to the advisor. As a fixed percentage of the premium, the value of the commission decreases over time in line with the corresponding rate of inflation. Before I conclude, to be able to harness inflation and make it work to our advantage helps us in ways we cannot even imagine. Life insurance is unique in that it has a natural hedge against inflation. The premiums we pay are locked in for the life of the life insurance policy, meaning they won't rise and fall with inflation. With each passing year, the premiums get cheaper with the corresponding rate of inflation, giving the policyholder the reassurance of asset protection. A life insurance plan tailor-made to suit our needs that considers the impact of inflation can provide our family with the right security blanket. This will ensure that our family has adequate financial protection in case of an unfortunate event. Inflation, our invisible friend. May the force of advantages of inflation in life insurance be with you. Please go through the description for the sources for this presentation. I've shared the link to my next presentation, Owning versus Renting, the advantages of owning a life insurance policy, at the end of this presentation. And do not forget to check out the playlists for more presentations. If there is something to gain and nothing to lose by asking, by all means ask. Thank you for taking the time to watch this presentation. I sincerely appreciate it. Namaste.